Ladies and gentlemen, it's Joel with Real Broker, and today we're going to go deep and look at a few case studies about the most catastrophic economic outcome ever, and that is a reverse mortgage crash. If you guys are ready, let's dive on in. Imagine a scenario where economic surges disproportionately benefit the affluent, leaving the majority struggling. This is in essence a reverse mortgage crash, where prices suddenly balloon upwards, allowing some to build substantial wealth while others are left behind. It's part of a vicious cycle. The rich get richer and the poor get poorer. The unsettling trend is evident in historical events and current statistics. For example, the 2000.com crash. Surviving tech companies turned 10,000% gainers. During the 2008 mortgage crisis, savvy investors scooped up foreclosures, and most recently in 2020, similar patterns emerge. Some experts think the U.S. middle class is shrinking at an alarming rate, with middle class wealth shrinking by nearly 50% while overall wealth has increased almost 30%. Additionally, the median household has yet to recover from the 2008 financial crisis, with typical American families having a lower net worth in 2016 than what they did in 1988. Recent reports show that the U.S. middle class population dropped nearly 61% in 1971 to 50% in 2021. And the wealth of the middle class has dropped 40% significantly since last year. The reality is the widening of the wealth gap is shown by some research. So let's take a look at a few specific case studies. Our first case study takes us to post-World War I Germany, a nation grappling with the consequences of the Treaty of Versailles. Initially, in 1941, the exchange rate was 4 German marks to $1 US, meaning everything was roughly equivalent to about 25 cents. However, after losing World War I, Germany was compelled to pay tens of billions of dollars in reparation for civil damages, and that, was devastating to their economy. The situation necessitated printing money on a massive scale. By the time they were done, the exchange had catastrophically shifted from 4 marks to $1 US to an astonishing 1 trillion marks for $1 US. Inflation accelerated so rapidly that in 1919, a striking example highlighted its pace. A student ordered a cup of coffee for 5,000 marks. Later, he ordered another cup of coffee with his total bill coming out to be 14,000 marks. Had he ordered both cups of coffee at the same time, it would have actually saved him money. This hyperinflation led to the government printing 1 trillion marks just to exchange for a single US dollar by 1923. An economic spiral that profoundly impacted German society and the global economy. Turning our gaze to Zimbabwe, one of the most well-known examples of a reverse market crash in history. Zimbabwe was famously known for printing 100 trillion notes that were only worth a mere 40 US cents. Their country suffered from extreme mismanagement and was subject to political exploitation. In addition to that, their government printed large sums of money to finance military operations and to ramp up food production. However, it turned out that they grossly underreported their money printing activities by $20 million a month. Subsequently, they started calling inflation illegal. This led to a complete loss in confidence in the Zimbabwe currency and caused prices to skyrocket. In 2015, the precipitous devaluation of this currency saw a $1 trillion note plunge to a mere 40 US cents. Government intervention, particularly in agriculture, triggered hyperinflation, reaching an unprecedented 9.6 billion%, and some measures painting a vivid picture of the devastating economic impact that the mismanagement and political exploitation could take on a nation. Next, we're going to look at 2 case studies that really hold deep to me because of, my Iranian and Argentinian heritage, adding a layer to the relevance in these economic narratives. Our exploration of Iranian's economic landscape reveals a stock market surge of up to 2.5 million points, and this was most recently in 2020, 2021. However, the growth is just juxtaposed against rising inflation, 40 to 60%, soaring interest rates up to 22%, and negative real interest rates echoing an impact of sanctions and economic challenges. Which leads us to Argentina, a country facing significant economic challenges. Recently, it was reported that Argentinian inflation reached a total of 142%. Since 1950, the average inflation rate has been a staggering 206% per year, indicating chronic economic instability. The tumultuous financial landscapes includes Argentina defaulting on their national debt a dozen times. In the past 10 years, the Argentinian peso has lost 99% of its value against the US dollar due to excessive money printing. The loss of the confidence in the currency led to reduced economic investment, worsening outcomes. However, an interest paradox arises. Due to these high currency devaluations, the stock market has seen dramatic increase, surging by 16,150% since 2020. This explosive growth in the stock market from 20,000 to nearly 640,000 points from 2020 through 2023 unfolds against the backdrop of negative real interest rates and escalating inflation. Argentina's experience illustrates a complex interplay of fiscal policies, currency devaluation, and stock market dynamics, providing a unique perspective on a reverse market crash phenomenon. Venturing into Turkey's economic landscape, we encountered a nation with a formidable military, but facing a 24-year high inflation rate of 85.5% in 2020. The president's decision to cut rates led to a 7,000% surge in the stock market, accompanied by negative real interest rates and heightened economic instability. And our final destination is Venezuela. Subject to President Trump's stringent sanctions in 2017, hyperinflation soared at 9,000% to astonishing 10 million percent in 2018 through 2019, painting a vivid picture of the devastating impact of economic sanctions on a nation. The stock market surge masked a deeper economic collapse marked by the plummeting of oil export and extreme interest rates. It's worth noting that Venezuela saw this exact same trajectory of inflation correlated with the reverse stock market crash. This raises the question of whether by all measures the same thing could also be happening here in the United States. Venezuela's experience serves as a cautionary tale of how economic instability can lead to a reverse stock market crash, offering insight to potential risks and challenges that nations may face. As far as whether this is going to happen in the United States, it's really important for you to understand the difference between nominal rates and real rates of inflation. On a broad scale, most of us are familiar with nominal rates. This is simply interest rates set by the Federal Reserve. It affects everything from how expensive mortgages are, how much you get paid in your savings account, or the yield on a treasury. So the real rate of inflation is when you take the nominal rate and subtract inflation, and what you get is something that's a much more reliable indicator. This becomes the real rate of interest. After the 2008 financial crisis, real rates briefly went negative and was even pronounced during the 2020 shutdown that rates went down to as low as 0.5%. So how does this relate to the overall context of reverse market crash? Three other economic catastrophes were eventually induced by periods of negative interest rates like Zimbabwe, Argentina, Turkey, and Iran. There's also abundance of money printing and borrowing. The government steps in to regulate and enact price control, and there's a loss of confidence in the economy. Many would relate that to what we're seeing with COVID and the way that times are currently. In terms of whether this is not or is actually something to worry about, I want to know, what are your guys' thoughts? Until next time, Joel with Real Broker.